Welcome to This Week in Local, a Localogy podcast featuring lively conversations about the local digital ecosystem, hosted by Localogy analysts Mike Boland and Charles Lachlan.
Hello, everyone, and welcome to This Week in Local. I'm Mike Boland, and my guest today is David Arslanian, who is Managing Director of Progress Partners. So, David, welcome to the program.
Great to be back. Thanks again for having me.
Yeah. So, David, Progress Partners is obviously a leading investment firm, and as such has been a keen observer of the topic on everyone's mind this week and last week, which is the fall of Silicon Valley Bank. So that's what we're here to talk about today, and to get your insights about, what it all means, what happens next, how this impacts our world at Localogy in terms of media and advertising sectors, and, what are the lessons and takeaways from this whole thing. But let's start basic. So, I think everyone has sort of heard this going on in the news. But for those who don't know sort of the background and the inner workings, give us a quick explanation of like how we got here, what led up to this. And I know it's sort of a very complicated and unusual set of circumstances that were sort of put in play to get us to this point. But if you could give us sort of the Reader's Digest version and how you see it.
Yeah, I'll try to keep it as brief as possible. But
right.
There were really two events that had to happen sort of simultaneously in order for a bank collapse such as this one to occur so swiftly. And some people might say, hey, it was building for a while. But at the end of the day, this was fast. I think everyone was taken by surprise at just how quickly it all unfolded. The first thing that happened that we all know about were the macroeconomic conditions that set it up, which were, in effect, interest rates were rising. And so over a period of the past 6 months, we saw the Federal Reserve ratchet up interest rates from what was 0.7% to 4.7% in what's widely been agreed upon as the fastest the Fed has ever increased interest rates. And so that was the first thing that happened. The second thing that happened, and this is the Silicon Valley Bank problem, was they didn't risk adjust their portfolio of assets for those interest rate hikes, which is surprising, I think, to a lot of people, because everyone knew the Fed was going to continue to increase their interest rates. So when you have rising interest rates and you have a bank that doesn't properly adjust for that, there's going to be a problem. And that's ultimately what we had.
Is it also fair to say, going back even further, when talking about sort of macro factors, we saw sort of the COVID-19 venture boom, right? And a lot of companies, a lot of recipients of funding had a lot of money to park, had a lot of cash on hand from all that funding. And, SVB was sort of at the time the elite place to do so. So they had sort of this massive rise in deposits, which is normally a good thing for a bank. Yeah. But that eclipsed their ability to loan capital. So then they had to sort of look for places to put it. And some of those places ended up being low rate, U.S. treasuries, things like that, which were then impacted by the, macroeconomic factors you mentioned, inflation, et cetera.
You got it. I mean, the key is when interest rates go up, the value of the treasuries that they acquired go down.
Yeah.
So the base value goes down. And it's actually not a problem until you are forced to sell one. And so what happened on Thursday was basically that Silicon Valley Bank had to sell one, and that one made them have to what's called mark to market, or reprice their whole book of holdings of these treasuries. Yep. And it dropped precipitously. And of course, everyone quickly realized the equity value of Silicon Valley Bank, which is to say their stock price, really was disconnected from where they were saying the price, the book price of all those securities were. And then you have the bank run piece of it was separate from the equity disconnect side of it. And that's something that I think I give a lot of credit to the Fed and the government. I don't normally give credit to the US government, but I'm going to do so here. They moved with incredible speed and swiftness in order to stem this and make people realize, just take a breath and realize it was a disconnect on the security side, not with the actual deposits themselves, which were backed by treasury notes. And that was fine. The problem was they had to sell and market to market.
Yeah, and you're right. The all things federal never move fast. So this was remarkable. Now, with respect to the bank run, that's another interesting piece as you sort of point out, because any banking sort of dynamics, it's built on trust. And what happened after Thursday was there was sort of erosion in that trust or a sort of perception of cracks in the foundation. And then, money just started pulling out. And then it sort of became a herd mentality, which exacerbated everything. Is that fair to say?
Yeah, it totally did. And I mean, this statement's been made before, but there really are only two things in life that exist if you believe in them. It's God and bank runs. You need to believe in them. And in this case, you just got that herd mentality of belief picked up that there was a problem, and people made quick moves to move their cash and their deposits out of the bank. And once you do that, a bank really can't survive without deposits. It's very straightforward.
Yeah, the momentum just builds from there. Now, so that brings us up to the present. Where are we now in terms of like picking up the pieces? I imagine there's a lot of sort of asset selling going on. And that'll lead us into sort of the impact in the marketing world I want to get to. But where are things now for SVB and its immediate sphere of influence?
Yeah, it actually portends to the broader market. Honestly, we at Progress had long believed that we didn't see the sharp downside that everyone was saying. This is probably a quarter to months ago. We didn't see a big upside in the market. We actually saw a pretty stable market. I think this shook the market again. Let me restate. This did shake the market. We're going to continue to see fallout from this for quarters, probably. I don't think it goes years. This is not akin to '08. This is something different. This is probably, though, we're going to have a couple quarters of unease within the markets as the banking system has to rebuild its trust again. SVB themselves was just a huge proponent of the startup market. So certainly, I think we're going to see some fallout from that. Yet to be determined the extent to which that impacts investing and selling activity. So I think we have probably a little bit of a shakeout still to go there. And then finally, I do think that if you can see through these quarters, you're still looking at what appears to be a fairly robust economy, which makes me feel a little bit more optimistic as you go into the back half of this year.
Yeah. Well, optimism is a good point to take a quick break. We're going to pause for a commercial break, and when we come back, more with David.
Hi everyone, it's Mike Boland, Senior Analyst at Localogy, here to tell you about L23. It's our annual flagship event, held this year in sunny San Diego, Coronado Bay to be exact, and it's all about charting the course of local commerce and tackling all of the factors and topics that continue to impact the business of local media, advertising, and commerce. So we've got a solid speaker lineup already, and we'd love to see you in Coronado Bay, April 17th through 19th, and you can find out more at localogy.com. Now back to our episode.
And we're back. So David, before the break, we were talking about, all the high level dynamics, what got us to this point. But we ended talking about sort of the fallout and some of your optimism. So I want to transition now into specifically what a lot of our listeners are interested in, which is how that fallout translates to any ripple effects in sort of this world of media and advertising. And I know that Progress Partners absolutely has a lot of domain expertise in terms of its portfolio investments in that world as well. So what should the companies in this particular world of media and advertising be doing or bracing for? And And what should they feel optimistic about? You mentioned that at the end of the first segment.
Yeah, I'll get into that latter in just a second. That piece in just a second, rather. We have been in advertising boom and bust cycles for a couple decades now. We've watched them, and we've been involved throughout that whole time. What we see is that the knee jerk is always to pull back on advertising media. It creates this just sort of feeling of savings of cash in a more challenging time. And so you see that as the initial wave. But then we always find, again, a quarter from now, 2 quarters from now, people realize they still need it. That is the lifeblood of a lot of these companies' revenue is marketing. So the companies that tend to come back first are the ones that are either direct response marketers or in some ways measuring revenue to marketing dollars. They come back usually. They're the first ones to push money back into the market and be a little bit more aggressive. An area specifically within that we see a lot of opportunity in is retail advertising. We were believers in this space years ago. We've really seen it pick up in the past 2-3 quarters, just the focus on that space. And I think it's because, again, it goes back to you can tie dollars generated to dollars spent. And anytime you can do that, it makes you feel better about the money you're spending, like you're actually getting something for it. And so that's where we see a bright light, and we think that'll be a opportunity area.
Now that's interesting, and we do see that all things performance-based tend to rise to the top in any sort of economic retraction or downturn. And another interesting point is that some of these downturns historically over the past few decades have tend to caused usually a retraction of overall advertising budgets from brands. But that's good news if you're sort of an emerging format and an emerging player. And examples of that we saw, after the .com boom and bust was the rise of Google and search advertising. And after the financial crisis and everything that happened in the late 2000s, though it wasn't new at the time, we did see an inflection in social advertising. So it's almost like this is an opportunity for media buyers and CMOs and anyone at a brand to sort of reshuffle. And that tends to frown upon legacy media and newer things, which tend to be performance-based, like search, as I mentioned, tend to sort of rise. So there's good news for some of those folks that are either in performance-based or experimental, new, emerging things. Like these days, it's things, like AR. I love the retail media example. You see retailers like Lowe's and Target have their retail media networks. And that's very performance-based because it's at the end of the funnel. If we're talking about store displays and things, it's advertising so close in such close proximity to a sale that it brings in that performance piece. Is that a fair statement?
Yeah, that the bottom of the funnel advertising is where we see, again, that's where you're going to be able to capture a lot of opportunity and value right now in this market. The other piece that I would just come back to, which you mentioned, was more smaller and mid-sized brands. This is a really good opportunity for them because the big brands are the ones that pull back. They're the ones that feel that immediate need to chop in big ways. And look, they spend the most, and they can pull out the most, right? But that leaves airtime for the smaller and mid-size brands, more local brands, to be able to put their dollars to work without having to compete against those bigger ones. The second piece that then portends to is to your point, the more traditional media, like TV advertising, it was really held for the larger brands. Mm-hmm. With the rise of not direct response OTT or CTV, but really being able to capture direct value in video advertising off of a device by saying it's in the home at this moment. And they also, I can tie that back to a website. They went to my website. Like that ability right now, I could see that as another area where people put more money at play coming out of this. I don't want to say it's today or tomorrow, but it's like coming out of this, again, that two quarter from now, I could see a lot of people focusing on that area because you're going to be able to capture that direct revenue to cost ratio.
Yeah. CTV is certainly interesting. So what then is the advice for the sell side of the media ecosystem, not just the brands and what's happening with them? You had a lot of great insights there. What should the publishers, the broadcasters, the online media companies that are, sort of fighting for that fixed ad pie, or in some cases shrinking ad pie, be doing? Is it, launching things that are more performance based? Is it sort of trying to innovate more with that type of stuff?
Surprisingly, they don't need to do a lot. They just got to be better at attributing, those revenue dollars that they're seeing to that. And they know that. They've known this for a long time. One thing that you'll see is as you get further and further away from the basic ratings game, and you get more and more into the direct response, direct attribution game, that's where the publishers, the supply side, just needs to be really cognizant and make sure that they're using technology that allows people to do that. Again, it's not like they need to do a lot. They just need to upgrade, and the upgrades at this point are not anything that doesn't exist, 3 times over in the market at this point.
Yeah, utilize all the sort of attribution technologies that are out there and sort of add that to what they have. That's a great point. Now, I think another challenge here too is not just all the macro factors that we've been talking about, but greater fragmentation in the supply side, because you have a few emerging players that weren't there or weren't as big in terms of, media selling powerhouses maybe 5 years ago. One of them is TikTok, and the other one is Amazon, as of course Amazon continues to elevate its own sort of ad program and its sort of search-based ads within its own network, which is prime sort of first-party inventory. It has very much of those lower funnel attributes you mentioned earlier in light of retail advertising, but in just, an online store. Any thoughts about what those folks are doing?
Yeah, actually, the fragmentation piece we saw about 2 years ago on the supply side. And we had a consolidation thesis going on with the supply side that was necessary because there were just too many players, both from a network's point of view, a publisher point of view. It's great that they're all coming online and you can buy direct and all this stuff, but it was just getting very complicated. And we believe that you were just going to see consolidation, whether it was actually on the supply side itself of the actual networks, or it was the technology being used to access those. There just needed to be some consolidation. I think we would have seen more of it had this most recent sort of macro event not happened. I think you would have seen it in Q3 this year. We'll see, but that's a long-winded way of me saying I agree. I think that you're seeing a lot coming out. I think that Amazon getting into this game, actually Amazon, Walmart, Target, developing their own networks, that's part of it, because they see the value that they can extract from brands, or the revenue they can extract, I should say, from brands by going direct at this point. And I would not be, too surprised to see that continue over the course of the next couple of years.
It's also great revenue diversification for them, particularly on Amazon, who's that big and just needs to constantly find new areas of revenue growth, which gets more challenging the bigger you get, obviously. So that's behind a lot of what it's doing there. Now, so back to SVB, and all of that, of course, relates to SVB in terms of what we could see that's symptomatic of, and ripple effects and macro effects. But back directly to not just symptoms, but causes. What is really the sort of biggest learning here? If we could treat this as a cautionary tale or a learning moment, what would that lesson be? You mentioned earlier better course correction to macro factors, if in terms of asset diversification for a bank like that. What else would you say there?
Yeah, risk adjustment, right? So I think one of the things we're going to see is a lot of boards are going to take a lot harder look at systemic failure points where you're over concentrated in one thing, and it turns out that keeping all of your funds at Silicon Valley Bank, maybe that's not the the optimum way to approach it. Maybe you need to have a couple different bank accounts or the ability to move funds rapidly from one bank to another. So I think that's something we'll see come out of this. I've talked to a lot of board members who told me, we had 25 million sitting in a bank account at SVB, and we just never thought that we couldn't access it one day, or that possibly the most we would get back is 250,000, and so I think that'll be a good lesson learned for a lot of people. And then the second piece, I think that look, we should take away actually just broadly is that the companies which use SVB, that they were sort of hyper concentrated in the startup community in some way, that was what they focused on, was both a fantastic benefit and what turns out to be a real revenue diversification or risk diversification problem. And so look, we can all take something away from that. Again, it goes to that risk and concentration that you've got to be aware of both those at the same time.
Mm-hmm. Well, that's actually a great place to end it, and that's all the time we have. But the good news is we're going to have you on stage in about a month in San Diego at L23, and we're going to continue this discussion and talk about the broader sort of environment in investing and all the dynamics beyond just SVB. But it'll be a good chance to sort of return to this topic 1 month later and see sort of where things are then. So until then, I want to thank you, David, for joining us.
Yeah, thank you. And I look forward to it. And hopefully it'll be a good discussion at that point.
Yeah, absolutely. And thanks everyone for listening. This has been This Week in Local. This episode was brought to you by L23, Localogy's flagship event taking place this year in San Diego, April 17th through 19th. And David, as we mentioned, will be there on stage. And you can find out more at localogy.com. Stay tuned every week for more episodes of This Week in Local. You can find the show on all major podcast networks. Please subscribe, like, and comment. So I'm Mike Boland. Thanks for listening and see you next week.
Thank you for tuning in to this week's episode of Localogy's This Week in Local with Mike Boland and Charles Loughlin. Be sure to subscribe for more.